Welcome to the Bookworm Duo, where we explore a variety of books. Today, we will explore a popular finance book that may help you grow wealth. Let's get started.
We are definitely diving deep today. We're looking at Personal Finance 101 by Alfred Mill and Michelle Kagan, CPA.
Right.
And it's a really fantastic guide, I think. It promises to help you take control and, importantly, keep control of your money.
Which ultimately means taking control of your life, doesn't it?
That's the connection it makes right away.
Yeah. The book kicks off with this really powerful idea.
Yeah.
Your finances, they're not some separate thing over there.
No, they're intertwined with everything.
Exactly. They actually give you structure.
Yeah.
And when you manage them well, effectively, you feel so much less stress.
And more empowered, right?
Yeah.
It's a strong opening because it immediately links your money to your overall well-being.
Mm-hmm.
And the core message is quite reassuring, I found. Because money management isn't some kind of super complex math equation.
Right. You don't need a PhD in finance.
Not at all. It mostly just hinges on, self-awareness and discipline. It really tries to demystify the whole process.
Yeah, that makes it feel much more accessible, doesn't it? And the book is packed with practical advice. I mean, from smart ways to cut spending, all the way to understanding the insurance you actually need.
Exactly. It covers, the whole gamut. Debt relief, retirement planning, budgeting, understanding credit.
The essentials.
Think of it as your roadmap, basically, to responsible money management.
And here's the exciting part, the real upside. The book suggests that getting these good financial habits down, it can lead to, amazing unexpected opportunities.
Yeah, it's not just about digging out of a hole.
No, it's about opening doors.
Yeah.
Maybe traveling to places you've only dreamed of, or, expanding your lifestyle in ways you hadn't even considered.
It's about building that foundation for a more secure, more stable life.
That's the empowering bit, I think. It shifts your thinking from just, okay, I got to manage these problems to, wow, I can actually create possibilities.
Making conscious life choices, yeah.
Okay, so you're ready. You want to take this journey of financial control. What's the absolute first step the book insists on?
It's crystal clear. You need to chart your course. You've got to set clear financial goals.
Makes sense, like planning a trip.
Exactly. The book uses that analogy, and it's a good one. Imagine setting off on a long journey somewhere totally unfamiliar without a roadmap.
You'd be lost pretty quickly.
Right. And that's apparently how many people approach their financial future. They just kind of drift, no real direction.
It's actually quite shocking when you think about it. The authors point out that most of us spend more time planning, say, a single vacation
Yeah.
than our entire financial future. We'll spend hours researching hotels for a week away.
Oh, yeah, definitely. Down to the last detail.
But our long-term financial plan, maybe later.
And that's precisely why specific, and this is key, written financial goals and actual concrete plans are so crucial.
Not just vague ideas.
No, they focus your efforts. Without them, that path to financial freedom, it can easily just lead to a dead end. Good intentions, unfortunately, just aren't enough.
This brings us to a really key takeaway, something you definitely want to remember from this section. Time. Time is actually your most powerful financial tool.
Absolutely.
Yeah.
Especially when it comes to saving and investing early.
The earlier you start.
The less you might actually need to save each month, and you'll likely still end up way ahead of someone who starts maybe a decade or even two later.
It really shows the power of consistency over just trying to throw a lot of money at it later.
It really does.
It drives home that old saying, doesn't it? Most people don't plan to fail.
They just fail to plan.
Yep. And without that plan, even the best intentions can just sort of fizzle out.
So like the book says, mapping out your route now is essential. It affects your whole future.
Okay, so you understand why goals are vital. The next logical step the book takes you through is figuring out your starting point.
Where are you right now? Exactly. The book frames it as knowing where here is before you can figure out how to get from here to there. And this leads us straight into the crucial concept of your net worth.
Right, your net worth. Think of it like your financial GPS reading.
Good analogy.
It's simply what you own your assets minus everything you owe your liabilities.
That single number gives you a snapshot, your financial health at a specific moment in time.
And it's incredibly important, isn't it? Knowing your net worth lets you set realistic goals, track your progress over time, make smart adjustments.
And it's super practical, too. It's really useful when you apply for things like a mortgage or a credit card or even a car loan. They often ask for it.
Well, one thing the book really cautions against, which I think is so important,
Yeah.
is the tendency to avoid listing your debts. People do it out of fear, maybe, or they think, oh, I've got a pretty good gut feel for my finances.
Like gut feeling can be dangerous, though.
Totally. It can be way off. And avoiding the full picture, especially not knowing your debts, can cause major financial damage if, say, a crisis hits.
Absolutely.
Yeah.
If you don't have a clear handle on your financial condition, it can seriously hurt you during difficult times, like losing a job. It makes planning for the future almost impossible if you don't know where you stand right now.
Okay, so how do you actually do this? Prepare this net worth statement. The book lays it out pretty simply.
Yeah, it's not complicated. You start by listing all the valuable things you own your assets.
Right, like your house, your car.
Even if you still owe money on them,
Yeah.
you list them at their current market value.
Okay.
And the loans tied to those assets, like your mortgage or car loan, those get listed separately under liabilities.
Got it. So assets could be bank accounts, investments, real estate, vehicles, even significant valuables like jewelry or electronics.
Exactly. Anything with market value.
And then you list your liabilities. That's all the money you owe.
Yep. Your mortgage balance, car loans, student loans, credit card balances, any other outstanding debts you have.
So you total up all the assets, total up all the liabilities.
And then you just subtract the liabilities from the assets.
Yeah.
Simple subtraction.
And the result is your net worth.
That's it.
If that number's positive, great, you've got a positive net worth. But if it's negative, and the book really stresses this.
Don't panic.
Exactly. Don't be discouraged. A negative net worth is actually incredibly common, especially for people just starting out in their careers.
It's just your accurate starting point, that's all.
Sure.
And knowing it is the very first step to mapping out your route to a positive net worth. You can't get where you want to go if you don't know where you are.
Knowing where you are is step one. Step two is deciding where you want to go. And the book says setting goals is basically deciding what you want and then figuring out a plan to get it.
Seems simple enough, but a big challenge for a lot of people is balancing those immediate wants and needs, the stuff you want now, with those short-term and long-term financial goals.
Oh, yeah. And this is where expenses become a real issue, right? They just have the sneaky way of expanding to fill up all your available money.
Inflation of lifestyle.
Right. It makes saving seem impossible sometimes. But the book offers a clear solution here.
Which is?
Focus on budgeting. Commit to spending less than you earn, which sounds obvious, but isn't always easy, and keep a much, much closer eye on your credit card spending.
That's a solid strategy. And the book really pushes you to do some deep thinking, some reflection on what you personally want to achieve.
Not what society tells you to want.
Exactly. Do you dream of retiring early?
Yeah.
Buying your first home, maybe getting that new car or boat you've always wanted? These are the aspirations that give your financial planning actual purpose.
And what's crucial here, the book points out, is choosing goals that are genuinely meaningful to you.
Right. It's not about chasing goals just because they sound like what you should want.
You have to ask yourself, is this goal really worth making some sacrifices now for that future enjoyment?
That critical thinking piece is so vital for sticking with it long term. And speaking of motivation, the book also mentions setting stretch goals.
Okay, what does that mean?
It means balancing ambition with achievability. You want to stretch yourself a little bit, aim high, but make sure your goals are realistic enough that you stay motivated, not completely discouraged because they feel impossible.
Find that sweet spot.
Mm-hmm.
The book also makes a really strong case for the power of written goals. Just dreaming about something apparently won't cut it.
No, you got to write them down and review them regularly. This gives you clear direction, and it makes the effort you put into saving feel much more meaningful. You see what you're working towards.
And the more detail, the better, right? When you write down a goal, include a clear description, a time frame.
Yeah, the deadline is important.
Yeah.
Creates urgency.
The specific amount of money needed, how much you've already saved, if anything, and a concrete action plan. Like, I'm going to put aside $100 a month by cutting back on eating out.
Right. Be specific about how you'll do it.
They use a great example. Don't just write, buy a house.
Uvig.
Instead, write something like, I want to buy a cozy Cape-style home with a water view on 2 or more wooded acres on the coast of Maine.
Wow. Okay, that's specific. You can almost picture it.
Exactly. The more vividly you can imagine your goal, the book says, the better your chances of actually achieving it.
That visualization is powerful for keeping motivation high. And the book also advises breaking down those huge, long-term goals, like retirement, which can feel overwhelming.
Yeah, decades away.
into manageable short-term actions, like setting a specific monthly contribution to your 401k. Small, achievable steps.
The book also touches on a common dilemma people face.
Hmm.
You have some extra cash. Should you use it to pay down long-term debt faster, like your mortgage, or save it for short-term goals, like building up an emergency fund?
That's a tough one. The book emphasizes really thinking through your current financial situation. There's no single right answer, and you need flexibility to adjust your plans as things change in your life.
And to keep that motivation going, the book suggests making a list of all the benefits you'll get when you succeed.
Yeah, remind yourself why you're doing this.
And keep visualizing that success. Leverage your subconscious with positive thoughts. Apparently, it can make achieving goals feel easier.
It's interesting. The book highlights something kind of depressing, but true.
Yeah.
The widespread lack of personal financial literacy.
Yeah, many of us just don't learn these crucial skills growing up, maybe not from our parents, and school often doesn't cover it well enough.
And that leads to financial mistakes that can unfortunately stick with you for decades.
Which is exactly why self-education is so critical. The book gives some actionable advice on where to start.
Like,
Reliable sources like, well, other good financial books, reputable magazines, they mentioned Smart Money, or Kiplinger's Personal Finance, and well-known online sites like NerdWallet or Investopedia.
but it also warns you, be cautious about just random personal sites that might pop up. The advice might not be reliable.
Good point. Stick to trusted sources. Okay, so goals are set. You're starting to educate yourself. Now we get to the cornerstone of financial control, budgeting.
The B word.
Yes, the B word. The book presents budgeting as your financial roadmap. And importantly, it really challenges that negative view a lot of people have.
Yeah, that it's all about cutbacks and sacrifice and misery.
Right. The book reframes it as the complete opposite. It's a powerful tool for achieving financial freedom.
How so?
It's about having enough money for the things you truly want without going into debt. The classic budgeting process involves, setting categories, tracking your spending,
Monitoring progress, making adjustments.
plugging those spending leaks, and staying motivated.
The core message is that a budget is fundamentally just a money plan. That's it.
Without one, many people just spend more than they make, often without even realizing it until they're drowning in debt.
Especially with credit cards. It's so easy to lose track.
That unconscious spending is the enemy.
So the goal is mindful spending. Deciding in advance how you want to use your money instead of just letting it sort of happen to you.
When you spend without a plan, you're not in control. And that, the book says, inevitably leads to out-of-control money problems.
Makes sense. So what's the real benefit of going through this process?
Awareness. Budgeting and tracking your expenses reveals exactly where your money is going. It really highlights how those seemingly small daily costs, that coffee, that lunch out, can add up to really significant amounts over time.
And that awareness empowers you, right? To make conscious decisions about how you spend or save or invest your money.
Ultimately, this can be the difference between always feeling broke and actually being able to afford those big, important goals like a down payment on a house, paying off debt, or, having a comfortable retirement.
The book also talks about what makes an effective budget. It's not one size fits all.
No, it needs to be flexible and realistic. It has to adapt as your life changes. A single person's budget is totally different from a family's or a renter's versus a homeowner's.
And critically, the complexity of your budgeting system needs to match how much time and interest you actually have.
Right. If you love spreadsheets and tracking every penny, great, go for it.
But if you don't, choose a simpler approach. The main thing is to create a system you can actually stick with long term. Otherwise, you'll just give up.
So how do you actually set up your budget? Where do you start?
You start by listing all your income sources.
Yeah.
And focus on your take-home pay, your net pay, not your gross pay before taxes.
Okay, income first, then expenses.
Yep. Next, you list your expense categories. Things like emergency savings, retirement savings, mortgage or rent, utilities, car expenses, credit card payments, student loans, groceries, entertainment.
The usual suspects.
Right. But here's a crucial point many people miss. You have to include non-monthly expenses.
Like holiday gifts or car insurance that you pay twice a year.
Exactly. Or maybe property taxes, occasional car repairs. Calculate their yearly cost and divide by 12 to get a monthly equivalent you need to set aside.
That's smart. Otherwise, those big bills hit you unexpectedly.
And this leads us to the golden rule of personal finance, according to the book.
Which is?
Pay yourself first.
Ah, yes. Heard that one before.
Make savings your #1 expense category. Treat it like any other bill. Set aside a specific amount each month. Don't just plan to save whatever happens to be left over at the end of the month.
Because usually there's nothing left.
Precisely. The book is very clear on that. Chances are there won't be anything left if you wait.
And through this whole tracking process, you learn a lot about yourself, right? Identifying your personal spending habits.
It's self-discovery. And the
Yeah.
point isn't to feel guilty about that daily coffee or whatever.
No.
No, it's just to bring those habits into the light so you can make conscious decisions. Do you really want that coffee every day? Or would you rather put that money towards something else you value more? It's about aligning your spending with what you truly want and need.
That makes sense. It's about conscious choices. Now, the book introduces a really interesting concept here, tied directly to budgeting and spending.
Opportunity costs.
Yes. Or, as they put it, the road not taken.
Basically, it means everything you can't use your money for once you've already spent it.
Right. So if you spend, say, $100 on a night out,
That same $100 cannot then be saved for a new car or used to pay down your high-interest student loans faster.
it's about the financial opportunities you miss out on by making a particular spending choice.
And these missed opportunities have both immediate and long-term consequences. Immediately, you just don't have the money for something else. Long-term.
You might lose out on the interest you could have earned if you'd saved or invested it.
Or conversely, you might end up owing more money in interest because you didn't use that $100 to pay down high-interest debt. So
Yeah.
that $100 spent today could actually cost you hundreds, maybe even thousands, over the long run when you factor in lost growth or extra interest paid.
Wow. That's a powerful way to think about spending.
It is, and the book clarifies this concept isn't meant to label spending choices as bad.
It's not judging you for going out.
No, it simply highlights the alternative uses of your money that you give up. It's about awareness, not judgment, making informed decisions.
Okay, so to make that budget really work, something you can actually live with, the book emphasizes needing to know exactly where your money is going.
Right. You need to set realistic spending goals, and you can only do that by first understanding your current spending patterns.
So the action item here is gather your documents.
Yeah, get as many bills, credit card statements, bank statements as you can find from the last 6 months, maybe even 12.
And then,
Then you total up your average monthly spending, including anything you put into savings. After that, figure out your average monthly net pay, your take-home pay, after taxes and other deductions. Focus on reliable income sources.
and remember, every expense counts, not just the regular monthly bills.
Definitely include those occasional expenditures we talked about, the ones paid quarterly or annually. Convert them to a monthly cost by dividing the annual total by 12.
Okay.
The book also points out that tracking cash spending is one of the trickiest parts of budgeting.
Yeah, where does all that cash go?
Exactly. Most people are genuinely surprised when they track it and see how quickly small cash purchases, that daily coffee, snacks, magazines, add up to significant amounts over time. Saving receipts or jotting down cash expenses immediately helps.
Once you've got a handle on these patterns, the next step is finding ways to cut costs comfortably.
And the book calls this a process of self-discovery, figuring out what you can most easily live without feeling totally deprived.
Good approach. And it advises starting with your largest spending categories first.
Right, because trimming those down, even by a small percentage, will have a much bigger long-term impact than cutting out tiny things. Then you can move to smaller, more discretionary categories.
Okay, so you're aware of your spending, you've identified potential cuts, now you set realistic monthly spending targets for each category.
Yep, start with your fixed expenses, mortgage, car payment, those are usually set. Then move to the variable categories, setting reasonable targets based on your habits and where you know you can comfortably cut back.
Then you do the math. Total income minus total targeted expenses. That gives you your projected net income.
Which might be negative initially, and that's okay. It shows you where you need to adjust more. If it's positive, that represents money available for things like extra debt payments or boosting retirement contributions.
And here's a crucial tip the book gives. Make a specific plan for any leftover cash.
Don't just leave it sitting in your checking account.
Exactly, because, as the book warns, money left floating in a checking account just tends to vanish.
It gets absorbed by miscellaneous spending, yeah.
The book also talks about combating impulse buying, which can wreck a budget and run up credit card balances.
The advice: plan your purchases. Wait at least 2 days before buying something not essential. Comparison shop. And try using cash. It makes spending feel more real.
Good tips. And for grocery savings, it suggests things like cutting back on prepared foods, buying family-sized items instead of single-serving snacks, opting for generic brands, Little things add up.
Hmm. And after tackling those smaller, relatively painless cuts, the book encourages you to review your larger expenses, what it calls the bigger leaks.
Like your mortgage payment, car payments, taxes, insurance policies.
Right. These might take more effort to reduce, maybe refinancing a loan or shopping around aggressively for insurance, but the payoff in significant budget relief can be huge. Absolutely worth investigating.
Okay, building on that theme of making things easier and more effective, the book talks about empowering your budget with technology.
And also harnessing the magic of compound interest.
Yes. Let's start with tech. Personal finance software and apps can be a total game changer, Rape.
Oh, definitely. Tools like, Quicken Mint, Personal Capital, YNAB, they can automate so much,
Mhm.
balancing your checkbook, paying bills, tracking your savings and investments, even creating your budget.
And they give you instant reports like plan spending versus actual spending, or a quick snapshot of your net worth. That's motivating.
The real beauty is that many of these tools link directly to your bank accounts, your credit cards, your investment accounts. So it eliminates all that tedious manual data entry.
Which makes it easier to stick with.
Exactly. And the automation provides these great charts and real-time reports, which really reinforces the whole point. The budget is there to help you become more aware and align your spending with your most important goals.
Okay, now for the financial superpower, as the book calls it. Compound interest.
This is fundamental. The book explains the difference between simple interest, where you only earn interest on your initial investment.
And compound interest, where you earn interest not just on your principal, but also on the interest that's already accumulated.
Right. It's interest on interest.
Yeah.
And that is where the real magic happens. It makes your money grow significantly faster over time.
It snowballs.
It really does. The book even shows how the frequency of compounding matters. Compounding monthly grows faster than compounding annually, for example.
And they use that powerful example of Bill and Jim investing in IRAs. Bill started earlier, invested less overall.
But ended up with way more money.
Right.
Almost double what Jim had, even though Jim contributed much more later on.
It just perfectly illustrates how starting early is incredibly powerful because of that long-term compounding effect. Time is your friend.
So is there a quick way to estimate this doubling effect?
Yes. The book introduces the rule of 72. It's a neat little calculation.
How does it work?
You simply divide the number 72 by the annual interest rate you expect to earn. The result is the approximate number of years it will take for your money to double.
Okay, so if you expect an 8% return, 72 divided by 8 is 9. It takes about 9 years to double your money.
Exactly. It's really useful for comparing the long-term impact of different interest rates. But, and this is a crucial warning the book gives, you can also apply the rule of 72 to debt.
Oh, interesting.
Yeah. It starkly illustrates how quickly high-interest debt, especially credit card debt, can double. If you have debt at 18% interest, 72 divided by 18 is 4. Your debt can double in just 4 years.
Wow. That really highlights why high-interest debt is so incredibly difficult to pay off. It's working against you with compounding.
Precisely. It's the flip side of the investment coin.
Tied directly to compounding and time is another fundamental concept the book covers. The time value of money.
Right. This basic idea states that a dollar you have today is inherently worth more than a dollar you receive in the future.
Why that?
Because today's dollar can be invested and start earning interest immediately. That future dollar hasn't had the chance to grow yet.
So this principle underlies a lot of investment and savings decisions, reinforcing the idea that delaying your savings or investments comes with a real, quantifiable cost, the lost opportunity for growth.
Okay, now let's talk about something the book says everyone, absolutely everyone, needs.
Let me guess. An emergency fund.
Bingo. It's truly your financial safety net.
Absolutely essential. Its purpose is straightforward. Provide peace of mind and cover your basic living expenses if something unexpected happens.
Like getting sick, losing your job, facing a big unplanned repair bill.
Exactly. Things insurance might not fully cover. And the book notes, if you feel uncertain about your job security or the economy in general, having that emergency fund becomes even more critical.
So the big question, how much should you have stashed away?
Financial advisors usually suggest 3 to 6 months worth of living expenses. But the book clarifies it's not really a one-size-fits-all rule.
Right. Some households might need more depending on their income stability or other resources they might have.
This is where having that budget is so helpful again. Once you have a budget, you can easily calculate how much money you'd need just for your basic, no-frills living costs if your income suddenly stopped.
And the book advises writing down your emergency fund goal amount and then committing a set amount to it each month, just like paying a bill.
Pay yourself first, again.
Yep. And where should you keep this crucial fund? Not just in your regular checking account, right?
No, definitely not. The book recommends a separate account that's easily accessible, liquid meaning you can get the cash quickly and ideally FDIC insured, like a high-yield savings account or a money market deposit account.
That separation is key, isn't it? Helps minimize the temptation to dip into it for things that aren't actually emergencies.
Exactly. Out of sight, out of mind, mostly.
What if you feel like you just have no extra money to save right now? It can feel overwhelming.
The book acknowledges that, but really highlights the power of starting small. Even if you can only manage to save a tiny percentage of your income at first, maybe just 5% or even less, it's absolutely worthwhile.
Because those small amounts add up significantly over time, especially with compounding. Even $25 a month makes a difference eventually.
Right, it builds the habit too. So what are some practical strategies the book suggests for boosting your savings, getting that fund built up?
Well, setting up that separate savings account we mentioned is a big one. It creates a mental and physical barrier.
Makes sense.
Utilizing direct deposit splits from your paycheck is powerful. Have a portion go directly into savings before you even see it. Or set up automatic transfers from your checking to your savings each month.
Automate it so you don't have to think about it.
Exactly. And if you do have to dip into your savings for a real emergency, the book has an interesting suggestion. Treat it like a loan to yourself.
How does that work?
Create a repayment plan and actually pay yourself back. Maybe add it as a line item in your budget until it's replenished. It reinforces the importance of that fund. Another great tip: leverage windfalls.
Like bonuses or tax refunds?
Yeah. Or maybe income from a side hustle or even cash gifts.
Yeah.
Use that unexpected money to accelerate your savings without having to cut back further on your regular spending.
That's smart. Also, when you get a salary increase or maybe you finally pay off a loan, like a car loan.
Don't just absorb that extra money into your spending.
Right. Funnel all or at least part of it directly into savings. You were living without it before, so you likely won't miss it.
The book also presents a really clear choice when you're saving for a large purchase, say a new appliance or a vacation.
What's the choice?
You can either make monthly payments to yourself into a savings account, earning interest before you buy the item, or you can buy it on credit and make monthly payments plus interest to someone else, like a credit card company, after you buy it.
Putting it that way makes the first option sound much better.
It really does. Delaying the purchase gives you time to reconsider if you truly need it, avoids accumulating costly interest charges, and you actually earn interest while saving.
Okay, so you're making smarter choices about saving and spending. But who handles your money also matters. The book dives into choosing the right bank or credit union.
Yeah, it points out that your banking arrangements and even your banking habits can have a surprisingly big impact on your personal finances, beyond just having a place for checking and savings.
So what are the key factors to consider when choosing a financial institution?
The book lists several important ones. Convenience is big, obviously. Access to free ATMs is another. A good, robust online banking platform is pretty essential these days.
And fees. You have to watch out for fees.
Absolutely crucial. Many banks charge monthly maintenance fees unless you meet certain requirements, like a minimum balance or setting up direct deposit.
And almost all institutions charge for things like bounced checks, stop payments, or overdrawing your account. Those overdraft fees can be brutal.
So the advice is really to think about your own banking habits. How often do you use ATMs? How much do you rely on online banking? Identify what services matter most to you, compare the fees charged by different places, and choose the one that fits your needs at the best price.
And a big choice here is banks versus credit unions. The book explains the difference clearly.
Right. Banks are typically for-profit, investor-owned companies. Their priority is maximizing profits for their shareholders.
Credit unions, on the other hand, are different. They're member-owned, nonprofit cooperatives, meaning they return any surplus earnings back to their members. This often translates into lower interest rates on loans, higher rates on deposits, and free or low-cost services. They prioritize their member customers over profits.
That's a significant difference. But what about safety? Is your money insured?
Yes, both offer government deposit insurance. Bank deposits are insured by the FDIC, and credit union deposits are insured by the NCUA. Both protect your accounts up to $250,000 per depositor, per institution.
Good to know. The book also touches on the huge rise of online and mobile banking.
Which offers incredible convenience, right?
Yeah.
Online banking lets you manage your money basically anytime, anywhere over the internet. You can view transactions, move funds between accounts, pay bills.
And many online-only savings accounts actually offer higher interest rates than traditional banks because they have lower overhead costs.
Mobile banking apps on your smartphone add even more convenience. You can deposit checks remotely just by taking a picture, make transfers, pay bills, check balances instantly.
Plus, things like payment apps, PayPal, Zelle, Venmo, make sending money to friends or paying online super quick and easy.
Okay, online banking is convenient, but what about security? Safeguarding your funds is obviously critical.
The book actually points out that online banking can be safer than traditional methods, in some ways fewer errors, detailed tracking of transactions,
Provided.
provided you are extremely cautious, especially with your login credentials and avoiding things like using public Wi-Fi for sensitive financial transactions.
Cybersecurity vigilance is absolutely key.
Mhm.
The book warns about common scams, like those phishing emails that look like they're from your bank asking you to click a link and update your account info.
Never click those links.
Never. Your bank will never ask for personal financial information like passwords or account numbers in an email. Just delete them immediately.
Other threats include malicious software that can steal information or even vulnerabilities on public Wi-Fi networks.
So the protective measures are clear. Use good antivirus and firewall software. Keep all your software updated. Enable two-step authentication whenever possible, and constantly monitor your accounts for any suspicious activity.
Physical security is also still important. The book warns about skimming devices that thieves can place on ATMs to steal your card information and PI.
Ugh, those are sneaky.
Yeah. The advice is generally to stick to ATMs located at actual bank branches rather than potentially less secure ones in malls, convenience stores, or airports.
Okay, what about overdraft protection? It sounds helpful, right? It covers transactions if you accidentally spend more than you have.
It sounds like a safety net. The book explains it's a checking account feature designed to cover transactions that would otherwise make your balance negative, thus helping you avoid those individual overdraft fees, which can be really high, like $34 per incident sometimes.
But there's a catch, isn't there?
There's always a catch. While it avoids the per-item fee, overdraft protection itself often comes at a price. There might be an overdraft protection fee, maybe around $12 on average.
Or worse.
Or if it's linked to a line of credit or even a credit card, you could be hit with very high interest rates or even upfront cash advance fees and interest. It can get expensive quickly.
So minimizing fees is key. How can you minimize ATM fees specifically?
The book suggests several strategies. Choose a bank that has a large network of its own ATMs. Plan your cash withdrawals so you can use your bank's ATMs or other surcharge-free ATMs in their network.
Maybe withdraw larger amounts less often.
Exactly. And utilize mobile banking apps for payments when possible. Definitely try to avoid those high-cost non-bank ATMs in places like convenience stores, hotels, casinos, or airports.
Good advice. Now, what about debit card safety? How's that different from credit cards?
The key difference the book highlights is that debit cards link directly to your bank account. When you use it, the money is deducted immediately.
Which means if there's fraud.
It can be harder to recover from than credit card fraud because the money is instantly gone from your account. With credit cards, you're dealing with the bank's money temporarily, giving you more time to dispute.
So what's the action plan for debit cards?
Monitor your accounts very closely. If your debit card is lost or stolen, report it immediately. Reporting it within 2 business days limits your potential liability for unauthorized transactions to just $50. Waiting longer can significantly increase your potential losses.
Wow, okay, speed is critical there.
Definitely.
So we talked about the emergency fund. Where are the optimal places to actually stash your cash, especially money you need relatively quickly, beyond just a standard checking account?
The book outlines several good options. Internet-only bank accounts often offer higher interest rates and may have no minimum balance requirements. The slight downside is transfers to your checking account might take a few days.
Okay, what else?
Money market deposit accounts, these are FDIC insured, but usually require a higher minimum balance, maybe $1,000, sometimes much more. They pay higher interest than regular savings, but you might face fees if your balance drops below the minimum.
And both internet savings and money market accounts usually limit you to 6 withdrawals per month.
Right, that's a regulation. Finally, there are certificates of deposit, or CDs.
Those are the locked-in savings.
Exactly. You agree to leave your money untouched for a fixed term, could be 3 months, could be 5 years, in exchange for a guaranteed, usually higher interest rate. The catch is the penalty if you need to withdraw the money early.
So, lots of options, depending on your access needs and timeline. The overarching theme seems to be controlling banking costs.
Yes, the book really stresses the importance of being aware of bank fees. Many people just don't realize how quickly those small charges for various services can accumulate and drain their accounts.
It's about making intelligent trade-offs, right, between the services you want and the costs involved. Like maybe maintaining a minimum balance to waive a monthly fee is worth it for you.
Exactly. And it advises keeping only the funds you absolutely need for daily expenses in your checking account. Move the rest to an interest-earning savings account. Even if interest rates are low, you're earning something, and you're protecting those funds from being easily spent.
So what are some specific actions the book suggests to minimize those common fees?
Okay, for monthly maintenance fees, meet the minimum balance, set up direct deposit if that waives it, or switch to a genuinely no-fee account. For overdraft fees, meticulous tracking of your balance in all pending transactions is key.
ATM fees.
Stick to your bank's ATMs or plan your withdrawals strategically. For returned item fees, like depositing a bad check, verify funds before depositing checks from people you don't know well. For paper statement fees, just switch to online statements.
Simple enough. The bottom line, the book says, is to actually read your bank's full schedule of fees, which is usually available online.
Yeah.
Know exactly what you might be charged for.
And if you want to compare rates and fees across different banks easily, it recommends great resources like bankrate.com and nerdwallet.com again.
Very helpful. Okay, next up, a big one. Mastering credit cards. The book covers, as they say, the good, the bad, and the ugly.
Yeah, and it starts with a really insightful point about the psychology of spending, what it calls the illusion of spending.
Explain that.
When you pay with a credit card, it just doesn't feel like you're spending real money in the same way cash does. Psychologically, it feels more like you're just borrowing it, delaying the pain.
Ah, I see. And the credit card companies know this.
Absolutely. They capitalize on this disconnect by offering really small minimum payments. It makes even large purchases seem like incredible bargains because the initial payment is so low.
And that's the slippery slope into overwhelming credit card debt for so many people.
Exactly. But the book emphasizes that if you understand how credit cards work, the terms, the fees, and use them wisely, they can be powerful tools.
Like for building a good credit history.
Right. Rather than becoming this dangerous pathway to debt, it's about control.
So what about the true cost of credit? What fees should you be aware of?
The book breaks down the various costs clearly. There can be annual fees, although many cards don't have them or waive them. The primary cost is usually the finance charge, calculated based on the annual percentage rate, or APR, the interest rate. Shopping for lower APRs is critical if you carry a balance.
And then there are other fees too, right?
Oh yeah, fees for applying, sometimes processing fees, fees for going over your credit limit, late payment fees, balance transfer fees, and especially cash advance fees, those can be really high.
The book also explains grace periods. What's important to know there?
The grace period is typically about 25 days, the time between when your billing cycle closes and your payment is due.
And if you pay your entire balance by the due date within that period.
You can usually avoid paying any interest charges on those purchases. That's the key benefit.
But what if you carry a balance from month to month?
That's where it gets tricky. If you carry a balance, the grace period often disappears for new purchases. That means interest starts accruing on those new purchases from the very day you make them.
Ouch. That adds up fast.
It does. The Credit Card Act of 2009 helped by mandating at least a 21-day grace period if one is offered, but understanding how it works with balances is crucial.
So how do you choose the right card for you?
The book advises considering how you intend to use it. If you're someone who religiously pays your balance in full every single month,
Then you should prioritize cards with no annual fee, or a low one you can maybe get waived. The interest rate doesn't matter as much if you never pay interest.
exactly. But if you anticipate carrying a balance, even occasionally,
Then the lowest possible APR becomes your absolute top priority, and a longer grace period is also beneficial.
and here's the part that's really eye-opening, maybe even a bit scary, the peril of just making minimum payments.
Yeah, the book gives a stark example, doesn't it?
It does. Imagine a $2,500 purchase on a card with an 18% APR. If you only make the minimum required payment each month, which might be just 2% of the balance.
How long does it take to pay off?
Get this, over 27 years. And you'd end up paying an additional $5,897 just in interest. The total cost for that $2,500 item becomes nearly $8,400.
Wow, that's staggering. It perfectly illustrates why relying on minimum payments makes it almost impossible to get ahead financially.
Absolutely. So the actionable solution is crystal clear. Pay any amount more than the minimum you can possibly afford. Even just an extra $5 or $10 a month can shave years off the payoff time and save you thousands of dollars in interest.
And the underlying message: don't use credit cards for purchases you genuinely can't afford to pay off quickly.
Exactly. It's borrowed money, not free money.